Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during her presentation. I have great pleasure of welcoming here Professor Cristi Gleason. Cristi Gleason is Carlson-KPMG Research Professor of Accounting and the Department Head at the University of Iowa. She is an editor at the Accounting Review. She received her Ph.D. from Cornell University. Her research is published in top-ranking journals in accounting, such as the Accounting Review, Contemporary Accounting Research, Review of Accounting Studies, Journal of the American Taxation Association, Journal of Accounting, Auditing and Finance, and the National Tax Journal. She has been a member of the editorial board of Contemporary Accounting Research. Current research interest is financial reporting for income tax, unrecognized tax benefits, financial analysis, corporate governance, interim financial reporting. Now we will start our seminar with the Professor Cristi.
Thank you, Mohammed. I appreciate it. I will go ahead and share my screen. And hopefully you're looking at my presentation. Great. Thank you. This is a lot more fun. I'm the department head right now, and so I really cherish opportunities to talk about research in any way. I've enjoyed being a participant in seminars that Mohammed's hosted, and so I really appreciate the opportunity to talk to all of you today and to get your questions and comments about this particular project. The title of the paper is The Measurement of Quarterly Earnings, Integral versus Discrete Method, and it's with two of my colleagues, Colin Coatney, who's at George Mason, and Lillian Mills at the University of Texas at Austin. And the question that we're interested in ultimately is which quarterly earnings measure has the greatest decision usefulness. And the reason, kind of how we got here in this level of interest is that over my career, I have spent a fair amount of time looking at quarterly earnings, and particularly in tax contexts. So I think most of you are not tax scholars, but both GAAP and IFRS have firms estimate the tax rate, the effective tax rate that they expect for the full year, and apply that in each quarter. And you know, so there's this very clear use of a kind of annual expectation to provide information in the quarter in the tax context. And over the years, as we have looked at this, one of the things that's really clear is that that's not how everything in the quarter is measured. And in particular, there are some significant differences in the theory behind how quarterly earnings are measured and reported under US GAAP and how they're reported under IFRS. And I think Mohammed mentioned that you're welcome to ask questions as you go. And so let me reiterate that because I appreciate the feedback. The US GAAP method is described as an integral method for the most part. And there are some exceptions. And so in a lot of ways, it's probably more accurate to call it a hybrid method. But just for simplicity, we're going to refer to it as an integral method. And so, you know, I've depicted this as a quarter is just a 1/4 slice of the annual pie. That theoretically, that is what standard setters are aiming to do for companies to provide shareholders with a sense of where the annual earnings is going. Now, it's a quite old method. In the 70s, it's got 50 years of reporting history in the United States. But when the International Accounting Standards Board created international standards, one of the significant differences in IFRS and US GAAP was the decision to have quarterly earnings be a discrete method. And what that means fundamentally is that the international firms that report under IFRS report what happened this quarter. So if it's a big quarter or a small quarter, they just report it as the quarter is, even if they expect some of these effects to even out over the year, that sort of blip gets reported. So my depiction of that is just, 4 jumbles of quarters that ultimately make up the year, but kind of have different patterns. And we'll talk more about the implications of this. So why do we think this is interesting, besides I've been looking at it for a number of years? The Accounting Principles Board actually debated both alternatives. And in the comments to the standard itself, that's actually where the integral and discrete method are primarily discussed. The trade-offs that they were making in choosing the integral method are more apparent. So on the one hand, the integral method should provide good information about annual earnings. On the other hand, it involves a lot of estimates and assumptions and potentially delays information. And so it's interesting that this debate occurs. There's very little research about the impact of this choice over other choices, and then IFRS adopts a different measure. So with about 50 years of history behind it, it seems like a good time to think about this. And one of the reasons we think it's particularly interesting are some of the changes in the reporting environments globally. And US firms seem particularly prone to this. I'll show you some evidence of that later. In the US, the reporting environment has shifted with a significant increase in the amount of non-GAAP reporting. And these choices are probably not unrelated, as I'll show you. Okay, so when the US standard setters were debating quarterly earnings, it's in APB 28. So sorry to put a lot of text on the screen, but I think it's helpful to start with how they framed the decision. They wanted the intra-period earnings, the quarterly earnings, they viewed them as an integral part. This is the phrase that they use, an integral part of annual earnings. And they wrote, interim financial information is essential to provide investors and others with timely information as to the progress of the enterprise. The usefulness of such information rests on the relationship that it has to the annual results of the operation. So they really put this emphasis on annual earnings predictability in making their standard setting decisions. Yeah.
So I don't know if I should read. Hi, how are you doing, Cristi?
Well, how are you?
Good, good. Thank you so much for presenting this paper. It's quite interesting to me. And so I'm just kind of wondering, maybe we will talk about it. It's like the earnings guidance, right? Because of people worry about, regulators worry about that for quarterly earnings guidance, it's kind of rather short term. So I wonder if you will talk about this. It's like the differences between these two systems. Yeah. How will that lead to the problem with the earnings guidance?
Yeah, I think one of the things that you're alluding to is not something that's in our tests explicitly right now, Agnes, but you are exactly, I think, hitting on one of the things that the integral method facilitates. So in some ways, the ability to estimate the overall annual effects and smooth earnings probably gives US managers more latitude to provide short-term guidance. And I think one of the costs potentially of the discrete method system is there is somewhat less of that short-term projection guidance, because you really have to know what's happening in this quarter. So I think you're hitting on one of the aspects of information. I don't know that my returns test will fully answer it, but I think they maybe allow me to tell you sort of where we think it's going. So I'll come back to that. And if I haven't done a good enough job, you can push a little bit more, because that might be something we could test more.
Thank you.
Yeah, thanks. If you're still trying to think, what does the integral approach mean? This is a little bit of an oversimplification, but it is, it's close to annualizing events. So just taking a quarter of events in any given quarter and just recognizing 1/4 of them. But it's also the, it also would include where you have lumpy expenditures that you hope will go away by the end of the year, assuming they will go away by the end of the year, and reporting amounts that you think will reflect where you're going to end up. So it's difficult because there are seasonal income and costs that occur. And so companies rely in the US, or companies that use US GAAP rely heavily on estimates. And I'm going to say the word discrete way too many times today. So I want to make sure I get us on the same page about these things. So IFRS adopted a discrete method of measuring quarterly earnings, but just to make everything extra confusing and maybe less helpful, whoops, I didn't mean to do that. The US termed a set of transactions discrete items. Okay, so in the US, these discrete items are things that within the quarter, you have to recognize fully in the quarter where they occur. That's the reason why the US system is not really fully an integral method, why it's a little bit more of a hybrid method that has some complexity to it. So I want to talk about what these discrete items are. I clicked, there we go. So for example, losses and gains on sales of assets or declines in inventory that are clearly not temporary are recognized fully in the quarter where they occur. So lots of things are recognized about a quarter, keeping earnings nice and smooth across the 4 quarters. And then some of these things are recognized fully in quarters, creating these little blips. And gains and losses are probably the one we're most familiar with, but tax settlements, extraordinary items, a need to have a valuation allowance, these are all things where the full weight of the charge or expense or gain are recorded in the quarter. So I'll talk more about how this, how we include this in our analysis, but hopefully one of the things that you can see is that US quarterly earnings has some complexity to it that using a fully discrete method gets around. So in 1998, the IASB actually set aside the view that a quarter was an integral part of a year and said, nope, a quarter is a discrete period. So interim periods are discrete periods. You report what happens in that period. And just to expenses, to give you kind of a sense of how it works, advertising expenses recognized when that advertising occurs. In the US, we teach our students that advertising is expensed. That's not quite right. Advertising is expensed in the year in which it occurs, but it can be spread out over the quarters evenly. And so under IFRS, the full benefit of the advertising is recognized in the quarter. So the expense is recognized in the quarter where the advertising comes up. So we always use the Super Bowl as an example, since it's early in the fiscal year and a really expensive ad buy for a lot of firms in early February. And then they can spread the cost of that advertising out over a full year. Administrative expenses are also something that companies can spread over a full year. And so you can think about all the expenses that companies incur in staffing. And if those things fluctuate over the quarters, a US firm might be smoothing them out, expecting to use less time in the 4th quarter. And under IFRS, they're going to go ahead and just recognize that lumpiness as it occurs. Okay, so you might be wondering how IFRS is going to solve the problem that the quarterly earnings might not be providing enough annual earnings information. And the solution is disclosure. And so companies are required to disclose information about seasonality, cyclicality, or transactions that are unusual in nature, size, or incidence in the notes. And so IFRS's remedy for this bumpiness is a disclosure remedy. And we're not going to look at the disclosures. We're going to look at the numbers. Okay, so how do we measure useful? Agnes hinted at one potential measure of usefulness, which would be the ability to forecast earnings looking forward. Because APB focused on the usefulness of quarterly earnings for predicting annual earnings, our primary measures are going to be the predictability of future earnings. We're going to look at both annual earnings, because that was the stated objective of APB 28, and we're going to go ahead and look at 4 quarters ahead, which is I think maybe the most common capital markets application. So the ability to just predict the same quarter of earnings next year. So Q1 to Q1, Q2 to Q2, et cetera. It has some benefits. It's measurable. It can be clearly measured. And it allows us to look at some alternative measures of earnings, which we think are important in this setting. And it ties in nicely to a lot of research about the impact of the integral method on the usefulness of earnings just in general. And then we're going to triangulate that with some returns measures, and I can talk more about Agnes's question. Okay, so one thing that I think comes up when you start thinking about how do I measure the earnings, the usefulness of earnings, is we often talk about, when we're thinking about predictability, about the limitations of predictability as a measure that's good. And the example I would normally give is, they could just make earnings $1 million every quarter. They could ignore all the usefulness of any signals and just somehow finagle the numbers to be $1 million every single quarter. And then it would be highly predictable. $1 million, $1 million, $1 million, $1 million. $1 million is next year, $1 million is the year after, but it's a garbage number. And so predictability in and of itself is not necessarily a virtue for any accounting number, absent some evidence that it is useful in that way. So what's different in our setting, and I think particularly important, is that we're holding the usefulness of the annual earnings constant. So the usefulness of US GAAP and IFRS numbers and the myriad of other standards that impact how useful those numbers are and what got rolled in to earnings is not changing. What we're looking at is the usefulness of how you break it into pieces. And so that allows me not fully to sidestep, well, are you sure they're not just, $1 million and it has no benefit? But it does mean that that's our primary concern, is not whether or not the ultimate earnings number is itself useful. And there is a large amount of research about the differences in incremental usefulness of GAAP and IFRS numbers at the annual earnings level that we're really grateful to be able to rely on. Okay, so our design is really simple regressions so that we can interpret the R-squareds. So we're looking at the predictive power, the R-squared from a regression where we estimate earnings in a quarter on earnings from 4 quarters before. And then we also estimate annual earnings on quarterly earnings. And so the first regression I would describe as maybe what the market is most interested in when it thinks about quarterly earnings usefulness. And the bottom regression I would describe as what the FASB had in mind when they were setting the standard. They wanted to know how useful quarterly earnings would be for predicting annual earnings. Okay, so you could probably imagine this is the biggest challenge. And for us, the largest challenge is getting an apples to apples comparison of firms. Because to the extent that there are differences in the predictability of earnings, then differences that we identify in the usefulness of GAAP and IFRS quarterly earnings might actually just reflect the underlying earnings of the firms. And so we match on size quintile and Fama French Industries, and then we match on the predictability of annual earnings and cash flow predictability. So we require the closest matches on those. And then we do one more thing. we remove firms with very different annual sales predictability. Okay, so what we are ending up with is a set of firms that have very similar earnings predictability, and the cash flows that underlie that are similar. And then the reason we included sales is because the matching of expenses to revenues means that to the extent that we got firms with very different sales predictability, we would be handicapping one set of managers. And I'll show you that for the results that we think are particularly important, we are really happy that the revenue predictability is not driving the differences we observe in quarterly earnings usefulness. So we end up with 28,744 firm quarters that are matched. So we have one US firm quarter and one IFRS firm quarter for each of those. Okay, so our expectations. We're going to split our sample into two groups. And the first group are firms that have highly predictable earnings. When earnings are highly predictable, US GAAP should be superior because it ignores those intra-year fluctuations. And so to the extent those fluctuations, by definition, if annual earnings are highly predictable, then the fluctuations that are occurring within the year are likely to reverse within the year. And so in that situation, annual earnings should have more usefulness when you measure it as predictability, because it is better able to predict the earnings 4 quarters ahead. That blip did not persist. And it's better able to predict the annual earnings because the blip is going to reverse. Those quarters, the initial quarter where the blip occurs and the quarter later in the year where it reverses, are going to be noisy for IFRS. They're going to have less predictive power 4 years ahead because neither the blip nor the reversal persists. And they're going to be less useful for predicting annual earnings because they both have an error just oppositely signed in them in predicting the annual earnings. So there's an implicit assumption here that managers can identify transitory shocks. And if that's not true, our prediction isn't useful. Okay, when annual earnings are less predictable, though, we would expect IFRS will be superior, or at worst, it'll be equivalent. So if the superiority of IFRS depends on whether you think the shocks are likely to persist into the same quarter. So the degree of persistence in the quarter in which they arrive will significantly improve the benefit of IFRS because it recognizes the shock. When earnings are unpredictable, a US GAAP manager doesn't recognize the shock when it initially occurs, and then they have to do a catch-up. So their initial quarter is less useful and the catch-up quarter is less useful in predicting earnings in the future. And they're less useful in predicting the annual earnings because that blip didn't get captured until later. So you'd expect to see a lot of fourth quarter noisy adjustments under US GAAP. So in particular, the fourth quarter is going to be quite hamstrung because it's going to pick up all of these extra catch-up adjustments. Okay, so I'm only going to show you lots of numbers on a screen for just a minute to give you a feel for how we did this analysis in our paper. The magnifying glass is out, which tells me that the fonts are as small as I think they are. So this is the table in our paper for the high annual earnings predictability sample and for 4 quarter earnings ahead. Oh, I didn't mean to click. So you can see that we estimate the betas, but they are not our focus because the multiplier on the persistence is not as useful or informative. We are interested in the R-squareds. And so I mentioned to you that we are particularly interested in making sure that our results aren't driven by differences in how predictable sales are. And you'll see that although there are some statistical differences in the predictability of revenue between US GAAP firms and between IFRS firms, that the actual economic significance of these differences is quite small. So the earnings predictability is very similar. But you can also see in our test that the US GAAP for highly predictable annual earnings, US GAAP earnings is more useful than IFRS in predicting earnings 4 quarters ahead, except for the fourth quarter. Okay, and I'm going to show you the low annual earnings predictability. And what I really want to draw your eyes to are these two revenue lines. So I had it right there. So both of these revenue lines, now you'll know how well I draw. You'll notice, and this is important for how we interpret the results, that revenue in our low predictability group, revenue is still highly predictable. The R-squareds of our regressions for revenue are very close to the high predictability sample. And so the implication of this for our analysis is that what is driving the higher predictability of IFRS earnings in predicting 4 quarter ahead earnings is not more predictable revenues. Because in fact, the US GAAP firms have more predictable or similarly predictable revenues. So if it's going to be driven by revenues, it should have been US GAAP. But also firms have highly predictable earnings. These R-squareds are in the 90s, 90% for both high and low earnings predictability firms. So hopefully that addresses some of these. And then here are pictures that don't have such small numbers. So you don't have to hurt your brain and can see the comparisons. So for high earnings predictability firms, we find that GAAP is better than IFRS for predicting earnings 4 quarters ahead for Q1, Q2, and Q3. Differences aren't large, but GAAP is superior. And that is consistent with high predictability firms not having to recognize intertemporal blips and then reverse them. And you can see that the fourth quarter is where they do equally well. And that really is an area where any of the true ups in US GAAP, you can see that the predictability of the fourth quarter for US firms is significantly lower in Q4 than it was in Qs 1, 2, and 3. And that is a feature of US GAAP accounting, that those true ups clutter up the fourth quarter and make those earnings a fair amount less useful. Okay, this is the low predictability earnings. So when you think about what the FASB had in mind, I think that this graphic, which shows that IFRS has more predictability for earnings 4 quarters ahead than US GAAP in the low predictability sample, raises a lot of concerns about whether the FASB's intention of providing informative earnings works, particularly for the sample of firms where information about earnings is most critical, right? These are firms that have less predictable annual earnings than the firms we were just talking about. These are probably the firms that standard setters are most interested in knowing something about, and yet IFRS does significantly better. And remember why it's doing better. Under IFRS, firms are recognizing earnings in the quarters where they occur. They're not estimating what's likely. And so in the US, firms are trying to estimate and smooth out the effects of quarterly blips, but because earnings are less predictable, their ability to do that is significantly smaller. And you can see that the fourth quarter true ups under the US GAAP, this tiny little gold bar in Q4, indicates the significant drop in the ability of US managers to provide useful earnings estimates when they're having to true things up. Okay, so remember the FASB's actual objective was to make earnings a better predictor of annual earnings. And although we see that for high predictability firms, US GAAP is a better predictor in Q1 and Q2, by Q3, that difference is mitigated. And if you think about this, I think this is somewhat intuitive. Under IFRS, as more quarters are occurring, the quarterly information set they're working with is better, and the patterns are appearing that make it more feasible to predict the annual earnings, and we see less of a difference. But this is the table that I think is maybe the most important to us. Remember, the FASB's objective was to provide the best information about annual earnings. But for low predictability firms, that is not the case. Those GAAP numbers, that integral method, does not yield more useful earnings for predicting annual earnings when annual earnings are less predictable. I think for us, this is one of the big takeaways for us as we're looking at this. If you're interested in high predictability firms, fine, but we could probably just take their annual numbers and divide by 4, and maybe that isn't, necessarily require lots of additional information. So I think Agnes alluded to this with her question about management forecasting. So this would suggest that management's ability to forecast earnings well in the US in low annual earnings predictability firms, their estimation skill is probably suggests that short-term earnings guidance is less informative and may make quarterly earnings numbers less useful to the extent that their estimates and their earnings management muddies up the waters. Okay, so
can I ask a question, Cristi?
Yeah, absolutely, Agnes. Do you want me back on that graph, or are you okay?
Yeah, it's okay. Yeah, of course you can back up. So I'm just thinking about your design, right? You identify that based on the firm level regression, I presume, and find out the annual earnings. I like to use persistence, basically. I think you're really looking at the persistence of the annual earnings to the next quarter, and then you'll find out high persisting type of group. Yep. You will see US pretty successful, in predicting that quarter. So that means that the managers, they are doing good job by making that predicted. In other words, that you are doing, say, okay, I find out they are high predictable, and you come back to see. Yep. Okay, so but what you're showing here is that managers, if they are successful to use their quarter to predict next year's quarter or predict earnings, then their annual earnings will be predictable. I can.
That the order
vice versa. So I thought they're just related, very much related.
Yeah, that they're not unrelated. Yeah. So Agnes, we're working right now on some out of sample tests that I think would maybe get at what you're talking about. I think one feature of. So one of the things that surprised us was the difference in the persistence or predictability of revenue. So my 90% and earnings. And that one of the things that indicates to me is that the difficulties that managers are facing in predicting earnings is not on the revenue line.
Yeah, it's not, because
right.
Yeah, I agree.
It's on the cost line. And so I think you're right in saying that there are implications. The way you get to high annual earnings predictability is also related to how well you are able to
do for quarters,
right? Yeah, that they're not independent.
So do you have statistics on what type of the firms are, like high predictability versus low predictability?
Do you mean like
high persistence or low persistence? Yeah, because your group, your sample, right? High versus low.
Yeah, they're split. It's a tercile split, and the middle is not in these tests.
I'm wondering what type of firms they are, like to drive that difference. And maybe it's just kind of that firm is very difficult to predict, or it's like a tech industry, things like that.
Okay, that is true that there are industry differences between our high annual earnings predictability and low annual earnings predictability samples. But there are not industry differences between the US and IFRS firms in the low predictability sample, because we required them to be similar size and similar industry pairs, right?
Yes, I understand. Yeah.
So I think you're totally right that there are definite industry differences. And I'm trying to think, I think in one of those early versions, when you have every table descriptive table you've ever run, we may have had that. But we could put it back, because that's probably something that might interest people in thinking about the results. And Agnes, I'm gonna have to think more about, I think I'm gonna like running the out of sample test, because it's obviously hard to do. The data for IFRS firms, the data series are not particularly long. And so requiring multiple years to estimate persistence.
Yeah.
I'm definitely, I think anybody that as soon as
I do think your finding is very interesting, and I'm just thinking about the implication for policy, because we know that in theory, integrated has its merit, discrete also has its merit. And so what type of firms, how can we let managers decide to use
which
methods?
method they want to be?
Can we, I'm just saying that because that's why I'm very interested to find out, even though you're matched, but what type of characteristic that firms should use.
Right, which should they have?
And then investor will also know, so when they look at it, and also I think manager provide guidance, there's a trade-off between these two methods. So along that line, I think it's very interesting.
I think so. So I think you'll like a couple of these things and some of their implications. So so one of the things that Agnes is alluding to is what would you allow, or what would policymakers do? And I think some of the next things that I want to walk through are things that helped us as we were thinking about what do our results imply for policymakers and about earnings numbers. And so one of the first questions, remember we matched on annual cash flow predictability. Okay, so for starters, remember I've already matched on annual cash flow predictability. And we looked at the ability of GAAP earnings to predict street earnings, analyst estimates, and cash flow from operations 4 quarters ahead. And we did this with some trepidation because those of you that have used international analyst data probably already know that the depth of the coverage between US firms and international firms really starts to differ. And so we worried a lot, and I'll show you a little bit more. We've looked a little bit more carefully at street exclusions and differences. And I don't know that we've nailed down all these differences, but we certainly worried about maybe earnings really doesn't need to predict actual earnings because it's got some junk in it. Remember those discrete items. And to the extent it doesn't need to predict actual earnings, then maybe we should be looking at both cash flow and street earnings. So when firms are highly predictable, GAAP earnings also does a better job of predicting street earnings in all 4 quarters. And it does a better job of predicting cash flows in Q1 and in Q4. Okay, this is interesting to us because remember that GAAP earnings is holding on to all those adjustments, and yet it's still quite effective at predicting cash flow 4 quarters ahead. We also see, though, that the cash flow predictability within the quarters is better for US GAAP firms. So I want to be more cautious about how we interpret the other tables. When we look at low earnings predictability firms, though, here we find the IFRS earnings provides better information about street earnings 4 quarters ahead. So our findings for IFRS and US GAAP across the high and low earnings predictability partitions are really consistent, even when we change what the target is. And so if they're trying to predict street earnings, they are still more informative for where street earnings will be 4 quarters ahead. And the cash flow predictability, where it's better for US GAAP firms. So what's driving this result is not that cash flows are more predictable for IFRS firms. They're actually more predictable for US GAAP firms. And yet the discrete earnings numbers under IFRS are more informative. They're more useful in predicting earnings 4 quarters ahead. So we wanted to think a lot more about, so I have predictability and it has some hurdles. And so is this useful? So a number of studies that have compared international and US numbers have used a methodology where they use an initial embedded regression, a nested regression that has, in this case, for the price regressions, we estimate price on the book value of earnings and on industry fixed effects. That's the nested regression, and we get an R squared from that regression. And then we add earnings per share to the regression. And then we look at whether or not the improvement in the R squared from adding earnings is better for the US GAAP versus the international firms. And we do this with both a price regression where the baseline includes book value of earnings and industry, and a returns regression where the baseline regression only has industry dummies. And then we add earnings, a measure of unexpected earnings, an indicator variable for whether the firm has a loss, and interactions between earnings, unexpected earnings, and both of those with the loss variable.
Dhaliwal, a question from the chair.
Yeah, Michelle.
Yeah.
Hey, Cristi. As you were talking about the earnings regressions before, my mind kept coming back to the idea of like, what's the incremental explanatory power of the quarterly earnings over the annual earnings? And so then as you were talking about this price regression, that kind of underscored it for me. So like, what was the advantage in the previous set of regressions of, doing the matching on the annual earnings predictability first, and then just looking at the predictability from the quarterly earnings versus trying to look at like, what's the incremental predictability of the quarterly earnings given the previous annual earnings number?
Yeah, so Michelle, we talked about this and we looked for papers in the prior literature that predicted Q1 earnings using the annual. And one of the difficulties in that setting is the difference between how US and IFRS firms handle seasonality. So I have to think about that, but you're suggesting that we use a similar regression setup where we have annual earnings predicting Q1 and then look at the increment annual earnings from year T-1.
Whatever the most recent available would be. So, given the most recent annual information, what's the incremental predictability of the quarterly information?
The 4 quarter ahead, the annual earnings for 4 quarters ahead, the annual earnings includes QT. So I have to think about this because there are models that use annual earnings for year T to predict quarterly earnings in T+1. But I think in this case, you would be talking about using T-1 and quarterly earnings from QT and quarterly earnings to predict quarterly earnings of T+4. Otherwise, the annual earnings itself has the quarter in it. And so I have to think about that because it does actually then have the information about how much it's smoothed out. So I think we didn't, I know why we didn't use Q of T, annual of T to predict T+4. And that's because the reversal information is actually in that annual earnings number. But I have to think about whether or not it would work to have T+1. I think I understand what you're asking, which is, can we be a little bit truer to the question we're asking, which is how do you break it up affect the informativeness of the number? I need to think about that more, because honestly, my punt here is a little bit of, there are a ton of models that predict quarterly earnings, and they're mostly random walk models similar to the one we're running. And so it felt like when people looked at it, they would say, yep, that's how you do that. And so I believe your R-squareds from that. But let me give that some more thought and see what we can see, if we can put that together, because I think you're right. These are two frameworks used in separate spaces. What we see in this space in looking at the price regression, so you'll notice that the nested model R-squareds for our price regression, remember this has book value of equity and industry fixed effects. And just book value of equity and industry fixed effects have a substantial amount of explanatory power. And then we look at the improvement in the R-squareds. One of the things that you can see and that we have noticed, but just don't have a good, I can't tell you why the underlying differences exist, is that the explanatory power of book value of equity and industry fixed effects for IFRS firms is quite a bit higher than the explanatory power of those of that initial nested model for GAAP firms. It's a really large difference, but our focus is on the improvement in the R-squared. And we find that GAAP provides better information about price in those interim quarters. The difference in quarter one is not significant, nor is the difference in quarter four. When we look at low predictability firms, so we're subtracting these R-squareds, IFRS has better information in quarters one and quarter two, and then by quarter three. So if you think about the earnings numbers are hamstrung in a way that price is not. The market is able to incorporate the cumulative information in these quarters. And as you get to quarters 3 and 4, where the US is having to begin to recognize these charges and incorporate the effects of reversals, and likewise for IFRS, any reversals are being incorporated, the difference in the informativeness of the earnings models goes away. It's only visible in those first 2 quarters, where recognizing the quarter as it occurs actually provides more information than manager's best guess. So Agnes, I don't know if this helps me or is just consistent with what you're expecting. The market, to the extent you think they're sort of fiddling with their numbers, the market seems to view the usefulness of these numbers as different in these 2 groups.
Yeah, it should be, right?
Yeah. So there, it's not just a window dressing story, unless you can't really use these regressions and then go, oh, markets aren't efficient, so I won't tell you that they're not efficient, because that would be kind of contrary to my tests. So the returns regressions, thank
Can
goodness.
Can I get back to Michelle's question?
Yeah.
Because of basically that when we look at earnings, we look at time series property, understand the property, and then when I know you did mention there's a lot of models they use, the time series model and per quarter, etc.
Sure.
And I like similar to Michelle's suggestions, like you are only using quarter 1 to predict next quarter 1, right?
Correct. Yeah.
But there are some models that information accumulate, and a Jensen quarter can also predict the next quarter. So I'm just kind of wondering, maybe you can also look into that, how this property goes by quarter 1 being predicted by, previous 4 quarters, and which is summarized of the 4 quarters is the annual. So what Michelle suggests is like you look at the annual and you look at the additional, but you can also look at the annual, make it to be 4 quarters, and then see how does they behave between those two models, to me, I'll be very interested in looking at that.
So Agnes, would you expect
The things like maybe eventually will come.
Go ahead.
Yeah, I would just want to, I don't know, maybe I'm interrupting you. Go ahead. I thought you were asking me a question.
No, I was going to ask, would you expect the integral method or the discrete method to fare better or worse if you put its adjacent quarter also in there? Does that help the US in some way? Does that mitigate some of the downsides of the integral method for low predictability firms if you put the adjacent quarter in?
I believe so, because all the information, you can think about the quarter's earnings measure, the real earnings with measurement error. And then you put all those 4 in there, and they may self-correct each other. And then maybe these 2 methods generally similar.
So one thing I sort of need to think of is when Q1 is being announced, the adjacent quarter, well, let me use Q2 because I can talk about adjacent quarters better. When Q2 is being announced, you don't have the adjacent quarter 4 quarters ahead. You have to build your expectations for Q2 4 quarters ahead. I completely agree that as you move through the year, your expectation about future earnings is going to change. There aren't a lot of models, though, that use Q1 from year T and Q2 from year T to predict 4 quarters ahead. That's not a common capital markets framework.
So I think maybe we're
using information that the trader would not have available in Q2 of this year.
If you're forecasting on the information available to the market, that I agree. But I'm saying like the time series property, I like to understand.
You're saying
how they evolve.
Get there,
regardless if the market knows about it or not, because we are evaluating the behavior of all those earnings property. And then if you wanted to look at the forecast, what's available out there, then we look at return, we look at forecast error, etc. So I'm talking really more about the earnings time series property.
Yeah. Okay. So thank you. That's helpful for us in thinking about what we want to include in the test.
Cristi, when you're looking at the incremental R-squareds here, so it looks like you're comparing just strictly the difference between the nested model and the full model. Would it be appropriate to think about that improvement relative to the baseline? So what's the improvement relative to the nested model? And given the different baselines for the 2 sets of standards, that might lead to even a more significant improvement in terms of what's happening with
the IFRS difference. Because so this is a good question, Michelle. The way we do the significance is we randomly assign GAAP and IFRS firms to samples to bootstrap the distribution of the R-squareds. So we could do the improvements. We could also bootstrap the improvements, and we've looked at that. And one of the things you're probably noticing then, sorry not to make people's eyes bug out while I flip back and forth between tables, but the nested R-squared for US GAAP firms between the high predictability samples, so you'll notice the numbers are in the mid 30%. And when we go to low predictability, they're still in the 30%. And this nested model, remember, has book value of equity and industry fixed effects. But you'll notice that for IFRS, the R-squareds actually really do swing substantially, and the book value of equity and industry fixed effects have a lot less explanatory power. So I think you're right. I think it would reinforce this message here. And because this is so high, I don't think it would change anything. And I think it would draw this up. We were trying to think about percentage improvements in R-squared and looked a little bit. So maybe you and I can talk more about this. I had trouble finding just a statistical context out just generically where percentage improvements in R-squareds were a good benchmark. And so we sort of just stayed with the Barth paper that we were building on. But I actually had the same initial kind of expectation that it would be sort of the percentage improvement that earnings triggered. And so here, these percentage improvements probably really matter because we're talking about much smaller numbers for the returns regressions. The nested regression only includes industry effects. So thank goodness, everything I believe about returns is still true, and industry fixed effects are not explaining a significant amount of returns differences. I think, I feel safe in a world where these numbers are at 1%, everything's okay. And then when we include, remember what we're adding here are earnings, unexpected earnings, and interactions for whether these are loss numbers to the regression. And when we add these in, for high predictability firms, we actually find hardly any difference except in Q4 when IFRS is superior. And so, and let me show you the others, because I think then that'll put this together. So when we think about returns, so I think having both the price and the levels, price and levels, I said them, got the same words, price levels and returns regressions is important in settings where we're not quite sure what we think are the right tests and the expectations. So price levels regressions, though, aren't fundamentally information tests, which is the way that I think most of us think about quarterly earnings. So when I think about these return regression tests, I think the return regression tests suggest that, remember, we talked about, I mentioned that the IFRS solution to the quarterly earnings discrete method information problem was to provide disclosures. And so I think one of the things this regression suggests is that the disclosures are sufficient to mitigate differences in the informativeness of earnings numbers for returns. And markets are able to impound the information they need about the persistence of earnings using disclosures. That's less true when the US GAAP numbers are handicapped. And so in the low predictability setting where I've shown you that the US GAAP numbers are less useful, there's, in fact, the IFRS numbers are better or more informative about returns, suggesting that the GAAP numbers are there's not any compensatory difference in the explanatory power. So since I actually am an accountant, fundamentally, the numbers themselves are really important to me. And so we spent a lot of time looking at how these numbers break out. And one thing that I think is really important in this setting are these non-GAAP adjustments. And so hopefully you'll let me tell you a lot more about them. We started with a really strong prior that is true, and that's that there were fewer street adjustments for IFRS firms than US GAAP firms. And you can see that the percentage of the sample for which street earnings equals GAAP earnings is just under 50% for US firms, and it's nearly 73% for IFRS firms. So there are fewer adjustments for IFRS firms, substantially fewer adjustments for IFRS firms. And so this surprised us. We expected it from the standpoint of what are analysts doing. But it surprised us a little bit when some of the first questions we got as we started down working on this paper, the questions had a flavor of something like, I think IFRS has more fair value adjustments and more write-ups and write-downs. So do you find that they have more adjustments and non-GAAP items? And so we went back to the table one more time going, well, and the answer really consistently is nope. They do not have more adjustments. So when we look at our firms, just to give you a benchmark, DeFond, Hu, Hung, and Lee estimate that the median IFRS firm in their sample has an adjustment that's about 13% of shareholders' equity, and firms have about a 30% likelihood of having a fair value gain or loss during their sample period. And that's fairly close to what we're observing here, where about 30% of these firms have a fair value gain or loss. So we think we're capturing the fair value gains and losses. We can't see them in the CompuStat data or in the IFRS data. You know, we can see the difference between street earnings and book earnings, but they don't provide a nice little list of what the adjustment was, but we think we're capturing those IFRS adjustments. There just are more adjustments to US GAAP firms. And the dollar values of these adjustments are significant. US GAAP firms have significantly more adjustments, and you'll notice that street earnings tends to be higher than US GAAP earnings, and that is not true for IFRS firms on average. So those differences are large. And we also noticed the univariate distributions, maybe, I really do like numbers. The univariate distributions show that the US firms have very large positive upward adjustments, and the IFRS firms have significantly larger negative adjustments. So, so then for us, one of the things that we were kind of just fundamentally trying to think about is, does this have a role for what we're documenting? And so I am going to make you squint at small numbers on a table one more time. I think one of the things that maybe Agnes's question about costs or about industry differences kind of hints at is about cost patterns for numbers. And so what I want to focus your eyes on are actually for firms with low annual earnings predictability. Oops, I've got to stop clicking on that screen. I can't talk myself out of that just automatic reaction that I can click on the screen. So if you look right here at the cost of goods sold as a percentage of annual cost of goods sold, this is for low predictability firms. So here's the same thing for medium firms, and here's the same thing for high predictability firms. I hope one of the things that you see really quickly is that for US firms and for international firms, these patterns are awfully close to 1/4 of cost of goods sold, of the annual cost of goods sold being recognized in any period. And you'll also see that the margins for low predictability and for high predictability firms, the level of the margins are different, but the margins themselves for cost of goods sold, whoops, my circling isn't great. But the margins themselves, cost of goods sold as a percentage of sales, are actually quite consistent, except for some fourth quarter true-ups. Okay, so given all of those things, then why am I making you look at this table? But now can we look at SG&A? Because what we noticed for SG&A is that US firms likewise have patterns that are very close to 1/4 with a fourth quarter true-up, while the patterns in their IFRS counterparts show a much higher degree of variability and more seasonal spikes into the fourth quarter. So you see a lot of evidence, I think, in the actual numbers. You can also see it in the margins. The margins stay very consistent for US firms with fourth quarter spikes, and the margins are moving for IFRS firms. So US firms are clearly smoothing SG&A. The difference in the kinds of behaviors we're documenting is driven by things below the gross margin line. Sorry, that scared me. Yeah.
Can I ask a question?
Yeah.
You look at, like, for IFRS, the fourth quarter, the SNG is much higher than all the other 3 quarters.
Yes. Yeah.
Is that, why is it? It cannot be due to the seasonality, right? Because firms have different type of seasonality. Is it because at the fourth quarter, they recognize a lot of depreciation, those type of
I think there are a lot of fourth quarter charges that are, and setup charges that are incurred in the fourth quarter.
In the IFRS number.
Yeah, under IFRS. Well, I wish I had cash, Agnes, because I'm not sure that those same patterns don't underlie the actual expenses in the US. but they get to smooth them.
Yeah.
They get to smooth them. So the anecdotal evidence we've talked to a few US CFOs, and they think these are end of year bonuses and payments in the fourth quarter. And in the US, compensation is smoothed. They're like, oh, it's in SG&A. Oh, that's bonuses and compensation on the SG&A line, because that's the admin seasonal bonuses at the end of the year. And those are smoothed. You anticipate those and recognize them over the year to the extent you expect to do them in the US. So that's the anecdote I have. I wish I could get my hands on, I wish the cash flow statement broke down the income statement a little bit better so I could land on that one, but that's the anecdote. It sounds practical to me. So this is just the seasonal, not the seasonality of the business, but the seasonal effect of fourth quarter compensation. Yeah. Do you buy that one?
Yes, absolutely. Thank you. Yeah.
Yeah, you would buy that from me.
Yeah.
So I think we think so one of the things that I actually really like about this analysis as we've dug into these numbers is that the US numbers resonate with what we think is going on and what we understand US GAAP is supposed to be doing. They're much smoother, and a lot of the effect is not in cost of goods sold. And that's a place where it's difficult for me to tell you a lot of stories about what it is that you would estimate where it would show up in cost of goods sold. So it's in the places where US GAAP and its integral method are most likely to differ from the discrete method. And that's one of the, I guess, test that we feel like triangulates that the thing we're looking at really is the thing that is occurring. Okay, so one last thing, and then I will wrap up. The hybrid method in the US is a compromise. And I started down this path of sort of thinking about accounting earnings sort of with a question of, is the compromise useful? So is it helpful for firms to be recognizing these discrete items in any quarter? And the answer is really clearly no. And here's the way that we see that sort of evidence. So these are only US firms now, and we're looking at the difference in the predictability. This is not going to surprise anybody who's done any pro forma studies at all. Excluding the discrete items from GAAP, so this second number always has higher predictability for earnings 4 quarters ahead, and the reason is because you might think, okay, well, street earnings, I don't really care, but it has better predictability for cash flows and for GAAP. So I think as you look at the increase in pro forma disclosures, one of the issues is, does integral accounting for quarters actually drive some of the increase in pro forma earnings? So firms have to use pro forma earnings to undo the effects of discrete accounting in the quarters, because they're required to recognize these full effects, and yet they are less predictive and so less useful to the market. Not surprisingly, full GAAP is more predictive for full annual earnings, which is not in my table, and that's mechanical. If there is a charge in Q1 and you recognize it all in Q1, it is in the annual. And so mechanically, those numbers map nicely, but it's not a better predictor of street earnings or cash flow from operations annually either, because a lot of those charges are non-GAAP. And so I think one of the takeaways that we have as we were kind of thinking about our paper, and I think Agnes mentioned the regulatory implications, where a third of our sample, just by definition, because remember, we just cut them into thirds to get low and high predictability. For a third of our sample, IFRS earnings are consistently more useful. I wish I could get a sample of US firms' earnings numbers to create the IFRS equivalent. We obviously can't do that, but we've tried to come as close as we can. And And the evidence suggests that the benefits of the integral method are outweighed by the difficulties in estimation when earnings are highly unpredictable. And the hybrid method, I think, could be described as a failure to generate relevant market numbers. And that in and of itself is likely to generate a demand for pro forma GAAP earnings. So I think I've come away from a lot of the tests that we've run, including the market tests, thinking that it's probably time for US regulators to reconsider the integral method, given the importance of timely quarterly earnings. So I appreciate you listening and your comments, and I'm happy to stay here for a little bit and answer any other questions people have. And it's nice to see lots of faces and friends from the US and around the world, so thanks.
Thank you very much, dear Professor Cristi, for your contribution and your effort. It's been really appreciated. Thank you very much. It's really an excellent presentation. Now, if anyone has any questions, you can open your mic and ask your question.
Bright, you can't have a, what's your question, Bright?
Hey, Cristi, I find your study very interesting. And when I think about the usefulness of financial information, I think about the relevance and the reliability, which is always a trade-off. So am I understanding it correctly that you're focusing more on the reliability side because of the estimation that's involved in the integral method? Like, like just trying to help me understand how to map it to relevance and reliability.
Oh, I would have said that we were tilted more toward relevance because we were heavily weighted on markets and their usefulness of the information. And we weren't very careful about reliability, except to the extent that we do look at whether it predicts annual earnings. I think our focus is actually a lot more on whether it's relevant. And it's interesting that you ask this because most of the discussions around relevance and reliability, I think, are appropriately focused on annual numbers. The quarterly numbers are not audited. So there, you know, and there is some evidence of restatements and corrections to quarterly numbers. They're far more common. These sort of audit adjustments to quarterly reported numbers are quite common. And I guess, so I have some sense of how to think about in the US setting, some proxies that we could sort of think about, like quarterly restatements, but we had trouble mapping that relevance. So I can't figure out how to do that for my international firms, Bright. If I could think about how to measure the reliability of those numbers, but the disclosure of quarterly earnings and the reporting regimes are a little bit different in ways that make it that sort of common US measure of did they change the Q1 numbers between Q1 and between the annual report. We had trouble replicating those sorts of tests in the international sample. So I have to think more about that. I'm not disinterested in relevance. You would think that the US system with estimates might be more prone to it. So I would like the tests. Yeah, I'm not disinterested in it. Figuring out what I can do in the international setting. So if anybody has thoughts about how to transfer those measures or better measures, I'm always game for better measures. I don't think we're disinterested in reliability, but I think we came down squarely in, is it relevant to markets? We did not focus on creditors. And part of the reason is that debt contracts are often written on rolling 4 quarters. So the most recent 4 quarters. So they are largely actually abstracting away from years and measures to begin with, and maybe have some tools to move around this. Yeah. Yeah.
Thank you.
Yeah, question from Lishu.
Hi, Lee.
Hi, I have a question. So I wonder, what's your take on the impact of new revenue recognition on this? Because now you focus more on the asset liability approach, and a lot of items are probably going to show up on a balance sheet earlier than all the revenue recognition policy. Does that somehow mitigate this fallback from this integrate method? If you can see it like as a contract asset, a contract liability, like say return liability earlier before it actually happened.
Does it fix more of this? Yeah, so I think I was surprised at how high the revenue predictability is in both the high predictability and the low predictability samples. Maybe surprised is an understatement because they're nearly identical. And so I really, when we were talking about this, Lee, I actually thought the difference between high predictability and low predictability was going to be revenue predictability. These issues around the new revenue recognitions, changes in revenue recognition policies, and I think in some cases they actually really do amplify the variability of revenue. So I was surprised that it was absent in the actual data, that revenue is highly predictable and that costs aren't. The question you ask, though, is one of the things that's interesting to me about it is the link between expenditures and revenues. And to the extent firms have more contract assets and future revenues, are they better able to plan what their income statements need to look like or can look like? So I think we should think more about, there aren't a lot of balance sheet variables in my test. You can tell that. So I think your question is related to Agnes's question to me before about the industries that are there. And that might help us think about how to provide some clear evidence about the costs. Interestingly, international firms have better information about labor costs and compensation for their workforce in their financial statements than US firms. So I think we might be able, like when you have these contract assets and liabilities, I think you can plan your workforce better, right? So your costs might actually be more predictable over time because you can see the matching that's going to occur. So I think it's possible. I will say that I definitely started thinking that the information firms were providing to the market was information about revenues. And I am now thoroughly convinced that's not it. And the information at the quarterly earnings is really about costs and costs below the gross margin line. So it's not really the revenue and the product costs. The things that are moving on the quarters that firms need information about are R&D, advertising, administrative expenditures. We looked at one point, I don't know if Colin ever actually ran it. I think we could pull depreciation out of this. Depreciation should be fairly predictable and just let the variability be in stuff you spend money and cash on. Yeah, thank you. That's helpful. I have to think a little bit about if we could run a pre and post R-squared test. I'll have to think about that one. I'm pretty sure I could find you the email where I said to Colin, are you sure you did this right? Are you sure the R-squareds for everything are 90%? Did you miscopy a line? Everything's 90%. Did you copy it right? So he added everything has 3 digits because of my, are you sure you did this right question, so that he could convince me that it was in fact 90%. So clearly my priors were off, bless his heart for putting up with my off priors. I remember saying, there's no way the low predictability is 90%. It really is 90%. Yeah, it's a great question. It's a great question. Mohammed, this is great. You assemble such a good audience and I really appreciate you doing this.
Thank you. Are there another question?
No, this is late in the day for all of you that are on the other side of the world. So I appreciate it. Or really early in the morning. Yeah, really late in the day. I know for some of you and some of you on the West Coast, this is a little early in the morning. So I appreciate it.
Yeah. Thank you very much, Professor Cristi, for your contribution and your effort. It's been really an excellent presentation. ended this. All that remains for me to say is thank you everyone that joined us, and I thank you very much for taking the time out to present to us today, dear Professor Cristi. It's been really appreciated. Thank you very much.
And thanks,
Yes,
everybody.
thank you, Cristi.
Yeah,
thank you.
thanks, Agnes. I
Bye.
appreciate the questions.
you.
Thanks, Bright. Thanks, Michelle.
And I hope to see you soon in Egypt.
Yeah, I hope so too. Yeah, thank you.